FASIHAH binti SHAHIDAN.
NUR'AIN IZZATI binti OTHMAN.
Muhammad NAZMI bin JAPRI.
We would like to present financial statement analysis of 7-Eleven versus Family Mart. Content of this video is background company, financial analysis of liquidity ratio, profitability ratio, market value ratio, and efficiency ratio.
Okay, now I will explain about our background company. First, it was 7-Eleven. 7-Eleven was founded by J.C. Thompson in 1927 as the Southland Ice Company in Dallas, Texas. Started as an ice vendor, the company eventually began offering milk, bread, and eggs on Sundays and evenings when grocery stores were closed. Okay, next one is Family Mart. Family Mart is founded in the city of Sayama, Japan on September 1973. Family Mart is a convenience store brand incorporated by Seiyu Group and currently headquartered in Tokyo, Japan. Okay, now we move to financial statement analysis. For liquidity ratio, the first one is current ratio. In 2019, 7-Eleven has only $0.55 in current asset for every $1 in current liabilities. Family Mart's liquidity is lower than 7-Eleven, which has a current ratio of 1.33. In 2020, 7-Eleven has only $1.63 in current asset for every $1 in current liabilities. Family Mart liquidity is lower than 7-Eleven, which has a current ratio of 0.75. And next one is quick ratio. Quick ratio in 2019, 7-Eleven has only $1.23 in quick assets for every $1 in current debt. Family Mart is slightly less liquid than 7-Eleven, which has $1.29 for every $1 in current debt. In 2020, 7-Eleven has only 1.31 quick assets for every $1 in current debt. Family Mart is slightly less liquid than 7-Eleven, which has 0.71 for every $1 in current debt. Cash ratio. In 2019, as you can see, Family Mart cash ratio is 0.78. This means that Family Mart has only enough cash and equivalents to pay off 70% of its current liabilities compared to 7-Eleven that has 0.13 of the cash ratio. This means that 7-Eleven only has enough cash and equivalents to pay off 13% of its current liabilities. In 2020, Family Mart cash ratio is 0.45. This means that Family Mart only has enough cash and equivalents to pay off 45% of its current liabilities. And compared to 7-Eleven that has 0.15 of the current ratio, this means that 7-Eleven only has enough cash and equivalents to pay off 50% of its current liabilities.
Okay, next, efficiency ratio. First, inventory turnover ratio. In 2019, 7-Eleven get 7 times move inventory much slower than Family Mart. Besides that, in 2020, 7-Eleven get 6.29 times move inventory much better than Family Mart 2.43 times. Total asset turnover ratio in 2019, Family Mart is generating 50 cents in sale for every one invested in asset, which is much lower than 7-Eleven 1.66. In 2020, Family Mart has generated 26 cents in sale for every one invested in asset, which is much lower than 7-Eleven 1.25. Account receivable ratio. In 2019, 7-Eleven get 24.56. It is slightly faster than Family Mart 4.80 in collecting account receivable. Furthermore, in 2020, 7-Eleven get 33.45. It is also faster than Family Mart 3.80 times for collecting account receivable.
Now we will take a look at the market value ratios analysis. There are 4 types of ratio. The first one is the book value per share ratio. The book value per share ratio for 7-Eleven in 2019 was RM 1.12, while in 2020, the book value per share is RM 1.10. The book value per share for Family Mart in 2019 is RM 34.14, while in 2020, the book value per share is RM 35.23. If a company's stock price falls below its PVPs, a corporate striker can make a risk-free profit by buying the company and dissolving it. If the book value is negative, where the company's liabilities exceed its asset, this is known as balance sheet insolvency.
Next, we will take a look at the dividend yield ratio. In 2019, the dividend yield ratio for 7-Eleven is 161%. It means an investor would earn 161% on their investment in the form of dividends if they buy the company's stock at the current market price. Furthermore, the dividend yield ratio for 2020 is 118%. It means an investor would earn 118% on their investment in the form of dividends if they buy the company's common stock at the current market price.
Next, we move to earning per share ratio. As for 2019, the earning per share ratio for 7-Eleven is 4 cents, which is greater than 2019, which is 3 cents. As for 2020, earning per share for Family Mart is RM2.60, that is greater than 2019, which is RM1.49. Higher earning per share are always better than lower ratio, as this means that the company are profitable and the company has more profits to distribute to its shareholders. Next, we move to the market value per share ratio. The market value per share for 7-Eleven in 2019 was RM1.43, while in 2020, the market value per share is RM1.34. The ratio as has been calculated shows that for Family Mart in 2019, the market value per share is RM1, while in 2020, the market value per share is RM1.01. Higher ratios mean investors expect a higher performance and growth in the future. This also means that loss-making companies have poor market value per share ratios. Meanwhile, low ratios are poor current and future performance indicator. This can also prove a bad investment.
Let's move on to profitability ratio. First, return of equity ratio. The return on equity for 7-Eleven from 2019 to 2020 show an increased amount of 19.42%. This ratio reflects the efficiency of generate profit from the shareholder money. The return on equity from 2019 to 2020 for Family Mart show an increased amount of 3.01%. This ratio did not efficiency of generate profit from shareholder money. Next, gross profit margin. For the gross profit margin, it presents a decline in 2020 where it declined at 3.2%. The result of the decline of gross profit margin described that 7-Eleven companies do not succeed in achieving higher revenue to exceed the cost of goods sold. For the Family Mart, it presents decline in 2020 where it increased 11.91%. The result of the increase described that Family Mart companies succeed in achieving higher revenue to exceed the cost of goods sold. Next, the operating profit margin also dropped from 5.09% to 4.64% in the year 2019 to 2020. As it shows, the drop from year to year for the operating profit, it expresses that 7-Eleven not highly operate their business as well to turn their sale into profit. Next, the operating profit margin also increased from 63% to 89.94% in the year 2019 to 2020. As it shows the increase from year to year for the operating profit, it expresses that Family Mart is highly operate their business as well to turn their sale into profit. 7-Eleven and Family Mart have stable current financial statements which is in good status. Based on current ratio, 7-Eleven is slightly less liquid than Family Mart. Reasonably conclude that Family Mart is more liquid than 7-Eleven. Given the high operating return on profit for Family Mart relative to the 7-Eleven, we must conclude that management of Family Mart is doing an adequate job of generating operating profit from the sales. Debt ratio indicates the percentage of the firm assets that are financed by debt. 7-Eleven more risk than the Family Mart because it is using more debt compared to 7-Eleven. Conclude that both of the companies show good condition in business because of the increments in return of equity.
Thank you for watching our presentation.